A question that arises frequently from our clients is, why do we use dimensional funds instead of Vanguard? The answer is quite simple. It's performance. Having a discussion about performance first starts with understanding the Fama-French asset pricing model. The Fama-French three-factor model, introduced in 1992, found three key factors that explain much of the variations in historical stock returns. Those three factors were market, size, and value. These findings led to a revolution that saw new index funds being built around small-cap stocks. Building globally diversified portfolios structured around these factors has yielded better returns over the long term. So if we can gain an understanding of how much a fund is exposed to these various factors, then we can start to make statements about future performance. We do this through multiple regression analysis. This type of analysis examines the correlations between the dependent variable and multiple independent variables. The question we are trying to answer is, how well do independent variables explain the variation of the dependent variable? If we were to give a practical example, looking at the Vanguard Value Index Fund, we would want to know how much the fund's variation is attributable to the market, size, and relative price factors independently. This is a multiple regression using the Fama-French three-factor model. By figuring out a fund's exposure to these factors, we can start to make statements about future performance. If you compare the Vanguard Value Index Fund with dimensional U.S. large value strategy, the dimensional fund outperformed its Vanguard counterpart by 2.18% per year. So I'm sure this begs the question, aren't both funds indexing value stocks? Yes, they are, but all indexes are not created equal. This can be seen in their individual regressions. Let's first explain the variables. Alpha is the excess return of a fund compared to its risk-adjusted benchmark. Market beta measures a fund's sensitivity to the market factor. A numerical value greater than 1 indicates the fund is more volatile than the overall market and vice versa. Small minus big measures the fund's sensitivity to the size factor. A positive number indicates an overall exposure that tilts towards small cap stocks, while a negative number indicates a tilt towards large cap stocks. High minus low measures the fund's sensitivity to the relative price or value factor. A positive number indicates an overall exposure that tilts toward value stocks, while a negative number indicates a tilt towards growth stocks. Adjusted R2 measures how well the overall model explains the variation of the fund, adjusting for the amount of independent variables. T-stat indicates the level of statistical significance of an estimate in the model. A level of 2 or greater indicates a high level, 95%, of statistical significance, making the estimates highly reliable. Neither fund has statistically significant alpha, which should be expected in a properly functioning market. The adjusted R-square for each is over 90%, which means the overall model used was successful in explaining the historical performance of each fund. When we look at the individual risk factors, Dimensional has a greater exposure to the market, size, and relative price factors. This means that the overall portfolio is slightly smaller in terms of market capitalization and is tilted more towards value stocks compared to Vanguard. All of these estimates are highly reliable, as indicated by their individual T-stats, and a greater exposure to these factors is likely to yield greater performance. You can also see that Dimensional outperforms Vanguard in the U.S. small cap and U.S. small cap value asset classes. So this must mean there are more sensitive exposure to the market, size, and value premiums with Dimensional. It is important to note that outperformance is not free. As we would expect in a properly functioning capital market, a higher return is associated with higher risk. If we plot each strategy in terms of standard deviation, we can see there are higher levels associated with the strategies from Dimensional. The additional uncertainty highlights the importance of patience and discipline when pursuing risk premiums. If you maintain discipline with the help of an independent wealth advisor, you can capture the overall benefits the capital markets provide the long-term investor. As Warren Buffett once said, The stock market serves as a relocation center at which money is moved from the active to the patient.